Good afternoon and welcome to our webcast. Today's Thursday, June 3rd, and my name's Rob Vaya. I'm the Director of Natural Resources here at AEGIS. We host these presentations every 6 weeks or so to keep you up to date on our views and what's driving the energy markets. And as always, we'll be recording today for replay if you'd like to revisit anything you hear or would like to share with colleagues. Here are our standard disclosures for some light reading here. We'll leave it here for just a second.
And those are important, but it'll also be available in the replay later.
Yep. So you just heard from him. I'm here with Matt Marshall, director of our research group. Good afternoon, Matt. We've got just a couple things to talk about here today, but how about you walk us through the agenda?
Yeah, I jumped the gun a little bit there, didn't I? Well, yeah, good afternoon. So we're going to start with oil today. We'll finish with natural gas, but we also have some explanation of how the AEGIS acquisition of Instanext announced last week is going to help our clients in a number of ways. I mean, beyond just the software, it's transformative in its own right. We have some fantastic new colleagues, and that includes, that's the best part. That includes Stephanie Barker up in Alberta. And she's a member of the market analytics team. You'll be seeing a lot of new Canadian content from an industry veteran who knows the physical movements of Canadian energy. She also has years of experience in trading and derivatives, and we're thrilled to have Stephanie on the team.
Yeah, very excited.
Yeah, and for the agenda today, OPEC has been changing their official stance on the global oil supply-demand balance. And if you extrapolate some of their conclusions, you can see that they are implying that OPEC will need some help in providing enough supply next year.
But what about Iran? If they strike a new nuclear deal with the U.S. and oil sanctions are rescinded, might that take away a chance of increased prices? I mean, we'll provide a few comments as well on the Instanext deal, why it's important for all the new features and the upgrades that we have planned here.
Yep. And in natural gas, we're at the low point of demand in the whole year. And that sometimes comes with what can look like bearish fundamental data. And for the rest of the summer, a few things really matter. Weather, always, but let's watch what happens with a couple new LNG facilities and how much gas is being consumed for power generation as the weather heats up.
Okay, well, great. Well, I think we've got an interesting agenda here today. And, before we dive in, a couple things, we welcome any of your questions. So just use the Zoom application and type your questions in there. If you'd rather not use the Zoom app, you can email us at research@aegis-hedging.com, and we'll try to incorporate your question or just let us know if you'd rather get a call back afterward. And as always, we've got to give a huge shout out to the team here, to Jay Stevens and Nick Hillman, as well as Stephanie Barker joining in there. There's kind of the new face, but I hope everyone listening has been able to connect with our team, and tap into the depth of the analysis that our team provides.
Yeah, and we'll get more and more Stephanie commentary here later, both online and in these webcasts.
Yep. All right, well, Matt, should we get started? You want to jump in on crude here?
Yep. So here's the first week. Here it is on the first week of June, and near-term prices are right back up to where they were around the beginning of March, and that's great news for our oil producer clients. But what they really like is the way oil prices farther down the curve have been behaving. So as a producer, you hate a backwardated curve. It means when prices get cheaper and cheaper and cheaper, the farther out you look into the future. The previous peak at the beginning of March, April prices were around $66, and you can see it right there on there. But the average future price for 2023 at that time was $52 or $53.
And now July prices are back up to a similar high, right? I mean, this time 2023 is several dollars higher, around 57.
Yeah, and why? That's a big question we get. Well, it may sound trite to say this, but it's a combination of more buyers in 2023 than there were, or maybe fewer sellers. And fewer sellers might be happening. Producers sell when they hedge. And among AEGIS clients, a lot of hedges went through in 1Q this year, a lot. So maybe a lot of the selling work was done back then. There's not as much left over. But economies are mostly opening back up after COVID vaccines and some herd immunity are taking over. And the demand side for crude oil has livened up. And we could be seeing more buying or even hedging going on the demand side. Speculators could be part of it too. Whoever it is, the bidders of crude oil are getting active.
Okay. And we're going to talk about what might happen in 2022, but That's a few minutes down the road here. So right now, let's take a look at a summary of the short-term risks to crude prices here first. So as many of you hopefully know, this is the AEGIS factor matrix. This is a short list of what we think are the most relevant factors affecting price. You know by now our way of looking at markets and that there's some risk skew there, but the only way to do that is to have an opinion about what the market already knows and has incorporated into price. If a factor is known and priced in, we put it closer to the bottom of the chart. If it's something that the market price does not yet reflect, then we put it up high.
Let's look at these three example over here on the left. You've got Iran, U.S. production, and non-OPEC production. And many forecasts have U.S. production essentially flat this year, but rig counts are up and prices are up. So is there a surprise in store? Maybe. Iran, there was just a ministerial meeting at OPEC this week, and they basically admitted that Iran's production was likely to come back, and prices went down after that, right? Nope, they went up. So there's a potential short-term bearish surprise working there. And then non-OPEC production, we could have put this at bullish and priced in if we wanted to, but we have it as a bearish and surprise potential.
So what happens if those bearish factors don't materialize and it was worry over nothing and the market was right not to weight those risks very much?
Yeah, then we're left over with a handful of factors on the bullish side that could keep supporting price. For example, if the US dollar continues its weakness, that should support oil prices. We'll show you a chart later. The product S&Ds, that's a new one for people who've been watching this. These are the refined products markets. Demand for fuel is really coming back. Some inventory levels are low. Refining margins in the US are attractive to increase fuels production. And when the product markets are doing well, it encourages more crude oil purchases to run through a refinery. So it pulls up crude prices by the bootstraps. And then of course, trend, you can't ignore the market itself. When a product keeps testing its previous highs, like crude oil has, it's a sign that buyers are in the mood to get in and stay in long positions.
Okay. Well, so let's get into some of these factors in a little bit more detail here.
Yeah.
So let's talk about Iran first, because we need to quantify that risk a bit before incorporating it into the global discussion, right?
Yep. So this chart shows total Iran production of oil, and it's a stacked column chart. So we separated the amount of oil that is exported from whatever is left, which probably means that it stays at home in Iran. So that dark blue amount, that's not exported, and it could instead go into storage. Okay, so in 2017 and 2018, you can see about 2 million barrels per day were exported, and Iran produced about 4 million barrels per day at that time. So that means that somewhere around 2 million stayed in the country. Skip to after the U.S. sanctions went into effect. Total production dropped by half to 2 million barrels per day, and exports were tiny. Right now, production is rising again. And so our data from Bloomberg says it's not exports, but I'm suspicious about that, and here's why. Maybe there is more oil being consumed inside of Iran, but that doesn't seem likely. But if it's not being consumed and it's not being exported, then Iran could be loading up every storage facility they can find, onshore and offshore in tankers. In other words, they're getting ready to export a lot more oil.
Okay. And they have a lot of floating storage available. I mean, it's about the size of Cushing's maximum storage when you add it all up. So that's big. And they can drain it all, unlike what we could do at Cushing, right? So, Iran also has a fleet of 40 tankers for storage, according to the shipbroker Gibson's estimates. 29 are so-called VLCCs, or very large crude carriers, where standard cargo sizes are 2 million barrels each. And 11 are Suez Maxes, which hold half as much oil, about 1 million barrels each or so.
Yeah, obviously these tankers are the easiest way to deploy and sell oil abroad. The onshore facilities may take longer to empty if they're going to empty at all. But how big are these tankers? If they're all full, then the tankers could hold 69 million barrels of oil. And that's almost 75% of current global daily demand, but it can't be delivered instantly. It's over time. So here's how it actually might work. If those ships sail toward destination ports and they deliver over the course of 2 months, then that's an extra 2 million barrels per day of extra supply for that 2 months. Keep in mind, that's the same amount that the rest of OPEC Plus was planning to bring back between April and July, about 2 million barrels per day.
So the market's going to have to find a way to absorb that oil. If demand is rising fast, then maybe it's not a problem. If demand doesn't match that increase in production, then there's going to be a problem.
Yeah, so here's the good news for those of you who would like to see higher prices. If they're right, OPEC thinks demand is about to really take off. They have had a major revision in their official outlook in the last 6 months. Go back to November of last year. That's the gray line on this chart here. And they were forecasting that the world would only need about 27 million barrels a day of supply from OPEC this year, or by the end of the year. But now they think that that amount of supply needed will be about 31 million barrels per day by the end of this year. You can see it up there. 4 million barrels per day revision. That's huge.
Yeah, that's big.
So this chart shows two things. In history, it's OPEC production. In the future, it's a forecast, but it's not a forecast of production. Instead, it's OPEC's official estimate of how much they could produce so that global inventories would neither rise nor fall. In other words, it's the amount of OPEC production that could make global demand equal global supply.
Okay. So this call on OPEC, as it's called, would rise if demand rises. If it would fall, or it would fall if non-OPEC production rises.
Right.
And so what we're going to show here in the next few slides is that OPEC might not have enough production capacity on its own to serve all demand. It's a huge change in attitude in the last 6 months.
Yep. So we took the current set of OPEC members and we traced back their historical production. And this group has produced 34 million barrels a day in the past. Okay. And you can see like right here in like in the first quarter of 2020, that number was around 28.
Mm-hmm.
All right. That's that figure right here in 1Q for January, that goes back to 1Q of 2020.
Okay.
And at that time, you can see OPEC had spare capacity of about 4.3 million barrels per day. But if you add in Iran on the green right there, then that number was around 6 million. So in 2020, when OPEC reduced its production to combat the loss of demand from COVID, they had spare capacity of about 8.6 million barrels per day without Iran and about 10.1 with Iran.
Well, and then if you skip ahead to this summer 3Q, they're bringing some production back. So the remaining spare capacity should be around 5.6 million barrels without Iran and what, 7.1 with?
Yeah, and they haven't announced anything else for ending production cuts. So let's
Okay.
hold it constant right there. And you can see we've got with OPEC is its spare capacity held constant in the future at that 5.6 plus the 1.5 from Iran. So let's compare this to demand on the next slide. And what we'll see is that the extra capacity of 5.6 million barrels isn't enough if demand grows quickly.
Okay. Well, and so what we're looking at here, I mean, this chart really shows a race, right? It's a race between how fast global oil demand can come back and how much spare capacity OPEC has. If demand grows more than OPEC can provide, then that's going to be bullish. It would mean that there needs to be production growth outside the OPEC group to keep the global market balanced, right?
Yeah, that's right. So two lines we've got here in dark blue and light blue. The dark one is if you count Iran's spare capacity, and then the light blue one is OPEC without Iran. So this orange line is OPEC's official forecast for demand growth. And we started at 0 in 1Q of this year. So that means that this represents additional or incremental demand growth as time goes on. Look how fast OPEC is expecting demand to rise this year. That's 6 million barrels per day between February and November. Very quick. And we tacked on a number for the end of 22 right here. That just extends the average growth in global demand in the last decade or so. So what can we conclude? Somewhere between 4Q of this year and 2Q of next year, OPEC runs out of spare capacity. Happens earlier if Iran isn't part of the equation. It happens later if Iran does start exporting.
And this is just one potential outcome, just a scenario.
One scenario.
Yep. It trusts an OPEC forecast to be accurate, but it's one big reason why you hear us recommend more costless collars and option structures for hedging here in 2022. There's a chance for larger upside if demand does this well and OPEC can't provide the supply needed, right?
Yep. All right, let's look at non-OPEC supply for
Let's
a
do
second.
it.
All right, so both the US EIA and OPEC are both forecasting supply growth out of the non-OPEC countries. The source of the growth might surprise you though. So on the left, here's the sources of supply. Remember that this includes all petroleum production, includes NGLs, refined products. And so that's why the US is close to 20 million barrels per day. If it were just crude, the number would be around 11 or 12. You could see both the EIA and OPEC forecasts in 2021 are slightly larger sorry. So you can see both the EIA and OPEC forecasts in 2021. There's slightly larger non-OPEC production in 2021 than 2020. So they're both calling for some growth. All right, on the right, what are the sources of that growth? So are you surprised that Canada is the main source of growth and not the US? Okay, it's big. It's like over 300,000 barrels a day. And then the second most is Brazil, depending on who you trust. We'll have to get Stephanie Barker to give us an update on Canadian production in the next webcast and some research pieces that we have planned. But
definitely.
It's easier to ramp up a bitumen mining program controlled by a few operators in Canada than ramping up a mass scale tight oil program in the US. Too many operators, a bunch of operators. Plus Canada is getting some help from infrastructure maybe late this year.
And Brazil, that's one big offshore project that's helping it grow. It's the Sepia project, and then there's some new additions from Norway there in the North Sea. So total non-OPEC production is forecast to grow by only 0.6 to 0.7 million if you take OPEC's word for it. EIA, they're a little more aggressive. And U.S. production, is forecast to decrease again here in 2021, but not as much as it decreased last year. But that might not even be true.
Yeah, that might not be true. So before looking at the production forecast scenarios over to the right side of this chart, let's talk about what happened in 2017 and 18, because there are some similarities and differences between that period and the one we're in now. U.S. crude oil production declined in 2015 after that nasty price collapse starting at the end of 2014. Then production started rising from about 8.5 million barrels a day up to a peak of near 13 million barrels a day just before COVID. After the production declines back in 2015, the PDP decline rate was very shallow. That declined PDP base meant that new production could more easily create total production growth. And that's the situation today too. PDP has declined in the last year, and it would be easier to make a total US production grow on top of that more depleted PDP. So are we about to see the same kind of acceleration in US production?
And the main difference we see and we hear from our clients for 2021 versus the last period of growth is an access to and cost of capital. And the dark blue forecast line on here is two things. For the rest of 2021, it's based on public companies' guidance. Then in 2022, we're reverting to economics. If each well's minimum rate of return would be 20% and new wells perform like old wells, then US production could rise up to 13.5 million barrels per day in 2024.
Yeah, 20% required rate of return used to be a good assumption. Today, if you combine the 20% required rate of return with an oil curve that was up over $63 when we ran this model, then you get production growth. But let's make the required rate of return 30% per well. That would represent a higher hurdle for spending CapEx on new wells. Growth would only come after returning cash to investors or maybe paying down debt. And at the higher rate of return, you do get modest growth in the short term, but you can see that that's the green line. You can see it peaks out at just 12.5 million barrels and then comes declines again. So this is very consistent with what we've heard from some public companies in the last year saying that $70 WTI is a better go forward break-even price rather than something in the high 50s like things used to be. And so we think OPEC is thinking this way too. They do not seem to be concerned about US growth at current prices. So let's switch gears for a second into a macro topic, inflation. It's been in the news a lot.
Just a little bit.
Yeah, let's add some thoughts to that. So this chart on the left, it shows the CPI, it shows year-over-year changes in the consumer price index, and that shot way up in the April numbers. Guess what the biggest contributor was though? It wasn't oil, wasn't a commodity. It was used car and truck prices. It's strange, but anyway, that explains a little bit about what happened there. Inflation is usually measured as increases in the prices of household expenses.
Raw materials, transportation, labor shortages, bottlenecks in supply chains, low inventories, demand for finished products, these can all contribute to higher household good prices, right? And so oil is an input into the raw materials, but also the transportation and supply chain. And what this means is if there is more demand for finished goods, then oil benefits from that extra demand and price usually goes up.
Yep. And so therefore, inflation is being led higher by end consumer demand, then oil prices usually benefit. However, it's also the expectation of inflation that benefits crude. And if the market has already priced in that expectation, it can be overdone. And this might be why we've heard recently from some people saying that inflation news is bearish for oil prices. If inflation is expected to taper, then oil prices might follow. All right, this is the chart on the right. It's a basket of commodities published by Bloomberg. Oil is only one part of a general increase in raw material prices. Look at the components. Gold is 12.7% of it. Gold prices are up. But then the next three are WTI, natural gas, and Brent crude. And so crude oil is only like 16.7% of it recently. Then you get into some metals, copper, aluminum, silver, all up, and then some ags. This BBCI is way up this year, and it surged in April. But raw materials have paused somewhat recently. That price increase is paused, and we're not sure where they go from here. Of course, we'll point out that all those are hedgeable. So if you're a consumer or producer of those, then we could help you out with that. But one last note on inflation. The discussion around inflation often gets conflated with the value of the dollar. And currencies are another force that acts on oil prices.
And for the last few months, WTI has traded in a range of around $60 to $66 a barrel. It dropped to 60 before bouncing right back, but it wasn't about supply and demand alone. The US dollar once again was influencing oil prices, right?
Yeah, exactly. See that V-shaped pattern right here?
Yep.
That maps directly to the price of oil. That green line is the value of the dollar against a basket of other currencies. And we flip the axis so that the green line is going up. That's weakness in the dollar. When the dollar saw strong days, oil prices fell. When the dollar saw a string of losses, then oil gained. And this is why we include the US dollar on our factor matrix that we showed earlier.
Right. Yep.
U.S. government been pumping literally trillions of dollars into the economy through direct payments, increased benefits, and it's likely affected inflation, but it's also affected the value of the dollar. And so we reiterate our point of view that the U.S. dollar remains a bullish risk for oil. Okay, we made a choice there to call it a bullish risk. We point out that anyone with, you think about interest rate exposure here and currency, we point out that anybody with floating rate debt should take notice of this too. And make sure you have a policy about whether you should hedge your floating rate debt. We can design a strategy for that too.
So switching gears to our special topic, Matt touched on it a bit earlier, but hopefully everyone saw the announcement last week of our acquisition of Instanext. We're really excited to have their CTRM powering our platform, and want to spend some time today outlining how this is going to impact our clients.
Yeah, you're forgiven as the AEGIS client if you don't get excited about a software system that happens behind the scenes. I totally understand. But there's some really important things you need to know about this that are going to be beneficial to you. Let's go quickly. What is a CTRM? It's a commodity trading risk management system. Sometimes you see them called ETRMs, or energy trading risk management systems. They do some basic things. Most of them will do the basics of recording trades. They'll value your trades. They'll give you some basic risk metrics, and they serve as a data warehouse for your trading portfolio, your hedging portfolio. Some of them have some advanced features, like they're stored in your data is stored in the cloud. The computations of your evaluations happen in the cloud. Some of them provide some simple reporting, or you can look back and look at historical valuations. And unique though, and I put a question mark after that, don't want to be too arrogant about this, but we think that this makes us unique too, is that because of the integration of Instanext with AEGIS, you're talking about complete integration front to back. Okay, that means that data never leaves our system. We have some advanced things that we can do that we don't think anybody else does, like workflow automation, matching up trades to your invoices and to your confirms to cut out some of the errors that can happen. Output to Excel, features beyond CTRM, like a trading platform that we have planned. And so this changes the way the service offering that we can provide to you. The most relevant thing to you really is that the feature set that we've been improving just consistently since the first platform came out in 2017 is going to keep getting better. Some of the things that we're working on behind the scenes are an API to be able to put your portfolio information directly into Excel. Pivot reports, like, that seems like it should be easy, but it's devilishly difficult, because in order to put together a pivot report, you have to be able to control all the metadata around the trades. And whenever your CTRM is not part of your organization, then you're having to convince a third party to come up with new features for you. It's hard, but we have a way around that now. Financial modeling, not just looking at price risk, but looking at total corporate risk as it relates to your commodity exposure, real-time risk modeling, so we can be able to instantly test the effects of new hedges or to see what is your new level of risk immediately after you put a hedge on. Accounting systems integration that we're working on. We want to point out that now with front to back integration, the data that goes into our system, it never has to leave and go into some other unaudited system or a system that we might not have complete control of. It's all staying in-house within our secure audited environment.
That's big. Yep.
Yeah. And then I don't have examples to show you for this right now, but there's also bilateral trading platform that we're developing right now. And this integration is a huge part of that. Okay. One of the instant things that you're going to see is new capabilities within Canada, and this also comes with two new people. These people are just fantastic to work with. Stephanie Barker, I mentioned earlier, her headshot was on the front. She's doing a lot of our client strategy and market research for Canada. Yep. But I didn't mention Bob Lee, and I really should have. Bob is industry veteran on the producer side and with midstream. You'll love Bob. And so hopefully a lot of you get to meet him. But these are two experienced financial and physical leaders in the Canadian energy industry.
Really excited to have them as part of the team.
Yeah, either working on infrastructure production or even in the banking sector. Great, great understanding, and just really keen understanding of the physical movement of molecules and the nuances of Canadian financial markets. The software team has been working with Canadian clients all along, and so they bring that experience as well. And you'll start to see more research and market commentary stuff from us on Canadian oil and gas.
All right, Matt. No, I appreciate the clarity to the clients on some of the new features and why it matters with our acquisition of Instanext, which we're very excited about. So, how about we move things over and jump into natural gas?
Yep. Let's start by looking at the natural gas forward curve and the changes it has undergone. This chart shows different parts of the forward curve is updated, just through yesterday. So after the long Memorial Day weekend, the market came back to some weather forecasts that flipped to hot. Really hot. Yep. It was mostly concentrated in the upper Midwest and Northeast, but it was 6 to 7 degrees Fahrenheit hotter for the second week of June, and price just shot up over 12 cents on Monday.
And this happened a couple weeks earlier too, right? We came in Monday to a bullish weather forecast only to just give it up.
Yeah, give it right back. This time it's having a little more staying power. That's great, and that's just in the front of the curve. That's what happened there. But what's been really encouraging has been the longer tenors. For example, you see the green line right there. That's next winter, so 2022 to 2023, and then the orange line right there. That's next summer, 2022. They have steadily been rising since mid-March. Next summer is starting to look like a good value for many dry gas producers, and we still think that there's room for that seasonal strip that summer next year to get better, mostly because we think the gas market is still undersupplied and will continue to be mildly undersupplied, but it looks like it's going to be persistent.
So again, here's our factor matrix. And how about we address the potential bearish surprises first?
Let's start on bear. So dry gas production, we don't expect Appalachia production to race ahead between now and mid-2022. There's just not any more pipeline space. However, we could see Haynesville production rising. And that area has been adding rigs, and there's been some guidance issued from companies expecting to increase production. So that's a risk.
Similar story for associated gas production. Aegis, we saw a lot of hedging activity as oil prices went into the 60s. Some of that seems to be hedging some growth. The Permian Basin is completely debottlenecked and gas can flow to market.
Yep. And to complete the bearish side, renewables, I mean, they have been taking a bite out of natural gas demand this year. It could be more pronounced if the wind blows this summer. Last year was fairly calm. And then weather, weather is always rapidly priced into the gas market. Until Monday this week, we would classify weather as having had a bearish effect recently.
Okay, well, so let's get to the bullish side here, and let's point out just a few. You can see there are multiple potential contributors to higher prices in the future.
Yep, and we mentioned renewables, but power generation in general could be strong this summer. Texas appears to be structurally underserved in generation, and that could create elevated power prices and call in maximum gas generation. The S&D balance, we'll show you a chart on that in a second. It's potentially bullish. Next several slides gives you some evidence of that. And then LNG, we have it kind of low on the chart. Yeah, and that doesn't mean it's not bullish. It just means it's mostly priced in. It's been flowing at high rates and high utilization, so everyone knows about it. But watch out. If a couple of projects arrive early this fall, there's a potential 2 BCF a day of surprise waiting for this winter.
Well, let's talk more about the S&D. If you have questions on these or other items, please feel free to throw those in the Q&A and we'll discuss.
Yep. Okay, remember how this chart works? Each dot is a weekly storage number from the EIA. And so we divide the injection or the withdrawal that they announce by 7 to get a daily BCF a day rate. And then the horizontal axis is the average temperature in the US. So you see this dot right here? That's not good. Okay, we haven't updated this chart with this morning's stat yet. And I think by the time we get to Q&A, we might be able to throw it up there. So if anybody wants to talk about this again, we'll do it. So that print that you see right there, that's for the week that ended May 21, and it was bearish. And it means that for the first time in a while, the injection into storage was larger than what the weather suggested should have happened. And when a dot is low on this chart, it means the injections are small after we control for weather. And the last 6 months of data have trended toward this 2018 trend line here in the gray, or just below it. And so this last dot was a departure from that.
Okay, but notice where that bearish dot is. It's almost exactly at the top of the curve, and that's going to mean that it happened at what might end up being the worst demand week of the year. So I would say probably shouldn't overreact on that, and actually, in fact, we need to see 3 or 4 stats to really make a judgment.
Agreed. Let's run a scenario based on some of these trend lines. Let's suppose that the next several dots come back to that 2018 trend line. Or maybe they're even better and they get to the 2017 trend line. What does that mean for summer? So let's assume that U.S. temperatures this summer, it's just the average of the last 4 years, okay? Not the 30-year or the 10-year normal, just the average of what we've seen lately. And now let's take that recent supply-demand balance from the previous chart and carry it forward. The withdrawal and injections into storage just based on average temperatures. And if we keep with the 2017 trend from the previous page, then we're on track to have only about 3,200, 3,300 BCF of gas stocks ready for next winter. But if we stick to that 2018 trend line, which has been the more common trend in the last few months, then stocks could get up to around 3,600. Okay. And that's a really reasonable level. It sets up this market to see prices much higher if winter turns cold, but this inventory level is high enough to make the market comfortably long if winter is mild.
And talking about recommendations, I mean, that's why you hear us recommend swaps as our standard hedging recommendation for gas the rest of the year. Yes, we do think this market is undersupplied, but a mild spring combined with higher gas prices means that some demand has been taken out of the gas market so far here in 2021. So prices don't need to be much higher to solve the supply-demand balance. The price risk, in our view, is only mildly to the upside at this point.
Yep.
But that's this year when prices have rallied. What about next summer and winter to follow? That part of the curve looks undervalued, at least from my standpoint. What do you think, Matt?
Yeah, and on a chart it looks extreme too. So this chart shows the price difference between January and April, just a subtraction. Okay. It rolls forward at the end of each December, and so that means that it's always looking at the next January and the next April. So through yesterday, that Jan-April spread was about 63 cents. That's the widest discrepancy in the last 7 years. And I actually think we could go back 10 years. But it makes an ugly chart if you add too many lines on here.
Yeah.
This chart shows the start of next summer is severely discounted versus this winter.
And there are 3 other years that started out looking this way, only to come in during July and August. So are we about to see a seasonal correction like we saw in 2016 or 2017 or 2018? If you have some more hedges to do for 2022, this is something you should be watching out for. An improvement in next summer prices could be a chance to layer in some additional hedges.
Yeah. So let's just say that we get some good surprises in the gas market this summer, and that tight supply demand balance that we described, it persists. How high could prices go? One governing economic relationship is how much gas demand is lost to coal and power generation. So this chart shows an AEGIS model that estimates the Henry Hub price, where gas gains demand versus coal, and then in the Henry Hub prices where gas loses demand versus coal. And we modeled every coal plant in the country, and we imagined that a gas plant sat right next door. So which plant do you run? the gas plant that buys gas at the nearest basis location, or the coal plant. And what we find is that mostly in Texas, the break even for gas versus coal is really, really low. And that's why you see cash gas prices in history with a lot of support at or around kind of just under $2. But we asked how high could prices go, not how low. So if prices this summer keep going up, you could see a lot of resistance starting at around $3. The competition with coal really picks up around 330. You can see a lot of bars in that area.
Yep.
And note that a lot of the switching comes in the eastern part of the country.
So if you're one of those who thinks that gas could be $4 or higher this fall or winter, keep this relationship in mind, that basically coal still matters. This idea may also help set the call strike on Acasa's callers. And if there is a lot of competition with coal over 330, then maybe set your cap somewhere around that level. But you want to turn over to the regional gas markets here, Matt?
Yeah, let's look at basis.
Okay. So the power generation chart on that previous slide there included basis prices, and basis is so much tighter than it was. I mean, well, really in a long time, right? And that means that coal can compete with natural gas at a lower Henry Hub price. That's the trade-off that you're going to see. And as a producer, you get better regional pricing, but the entire market loses some demand.
Yeah. So this shows regional markets throughout the country. The Appalachia basis locations up here, like Dom South, not doing well. It did even worse this week when some problems on TETCO were announced. That's the rough spot. TETCO didn't get approved to run at high pressure for the next 90 days. I think PHMSA made them reduce pressure on the line, and it may be worth a 1 BCF a day loss in flow rates. So that was bad news for Appalachia. But if you look elsewhere, connected to the Rockies or West Texas, August basis is really amazing. Permian producers, I promise you that right there, that zero is not zero price. You can trust me. You're going to get paid for your gas this summer. That zero basis means it's parity to Henry Hub. And then in the mid-continent, just north of there, that's just a 19-cent discount to Hub as of 2 days ago. So Eastern Rockies also getting the benefit too. Less gas competition there at CIG. They're making less gas in that area these days as well. So the market is kind of uplifted. It helps keeps their basis elevated. So some good things going on in basis this summer.
That's great to see here for the summer. So how about we switch it over and take a look at winter?
Yeah, let's start with Appalachia again.
Okay.
That kind of discount for Dominion South during winter, that's really unfortunate. I mean, it's a sign of continued lack of transportation capacity. It's been moving lower for months. And for those producers who do have the capacity on pipelines to get over to the New Jersey area and the Transco pipeline, winter still has a premium, so they're still selling into a premium there. But that's just a handful of people.
Right.
Elsewhere, looking really good. Waha positive for winter out in West Texas. CIG in the Eastern Rockies gets a 10-cent premium over Henry Hub. Opal over in Wyoming, it's a strong 55-cent premium. Once again, that's a market of a limited size constrained by pipeline going into the Opal area. And then the mid-continent producers essentially equivalent to Waha.
Speaking of Waha and the Mid-Con, let's talk about what that means when Waha and Mid-Continent prices are equivalent. It means that there is no need, nor is there an economic incentive to move gas north out of Waha. With the addition of the Whistler pipeline here this spring, on top of 2 big Kinder pipes in the last 2 years, the Permian Basin has all the capacity it needs in going east to the Texas Gulf Coast or to Southern California or to Mexico. It doesn't need to send any gas north, right?
That's right. Therefore, like we don't expect Waha to get much better than it is right now, but we don't expect a meltdown either. It has pipe capacity to spare.
Okay.
One more thing on summer, we talked about weather. Weather's always important. This is the most recent seasonal outlook from Commodity Weather Group. I've been using them for 10 years. They're a good shop. If you need weather analysis, it's a great place to go. They looked at analogous years in the past, and they see an almost even chance that the summer could be hot versus mild. It averages out to just average. It looks average. But the important point to note about it is that last year was hotter than the 10-year and the 30-year average, but this year they're forecasting it right down the middle. And they cite a few things which mostly go over my head, like most meteorology stuff. But among them is increased global wind. It's like the jet stream, but all across the globe. And that may also lead to some higher wind generation in the U.S. So watch out for some possible higher utilization of renewables while this summer struggles to keep up with last year's hot weather.
Okay. Well, so how about we take a look at LNG capacity and whether there might be some cancellations this summer?
Cancellations. I don't think so. We really don't think so. There's too much money to be made right now by sending U.S. produced LNG to either Europe or Asia. This chart shows the prices of Henry Hub down in green, and then the dark and light blue lines above it, they're Asia and Europe prices. So you see how all three lines touched each other last summer? That was zero profit. It was actually negative profit in exporting LNG out of the U.S. And it wasn't just COVID. There was too much gas in Europe too.
Now that profit's large. It's really large, right? So how about we dig into why? Give me a little bit of background on that.
A big reason is that Europe was cold this winter and they depleted their storage. So usually their inventories bottom up around the end of end of March, going into the 1st of April. But this year they just kept dropping. So Europe went from extremely high inventories like all last year to the point of where they were turning away multiple LNG cargoes, and now they're at a 5-year low inventory. They need gas, and we don't have a slide on it, but Asia had its issues with supply this winter too. Gas prices and power prices and LNG tanker rates, they set recent records. They needed gas and continue to need gas. So all in all, we don't see a threat of material cancellations of LNG cargoes out of the U.S. this summer.
All right.
In fact, there could be a surprise in storm for this winter that's coming. LNG exports could pick up. This chart shows each U.S. LNG project and their start date and their volume. The hatched ones up here are the future ones.
And two more potentially coming on this fall, the big one being Venture Global LNG in southern Louisiana. And there were reports that the operator had put out tenders for loadings here in October.
Yeah, we don't know what their utilization rate will be, but they have about 1.2 BCF a day of stated capacity. And then Cheniere's Sabine Pass Train 6 might be here before winter too. And that means that the total LNG capacity additions from here through winter could be close to 2 BCF a day.
Okay.
And that's what we have, Rob, covering oil, covering gas. Definitely reach out to us via email if we don't get the questions answered here. But we're about to jump into the Q&A session, and if you haven't already put in your question, put it there. If you'd rather not, if you'd rather not say it in front of everybody, you can email us, and we can answer you offline if you like.
Always happy to talk.
Oh, very good. Well, if we can just jump straight into the Q&A if you want. I know we had a few written here, a couple about power and a couple about how that S&D balance will look going into the winter. So how about I just do them in reverse order, and Jay Stevens here feeding them to me offline. So the question was, your analysis for storage is temp adjusted versus withdrawal. Should wind and solar, as they penetrate the stack, shouldn't those be adjusted for as well? So yeah, you can do different variations on this. The chart we're talking about is that scatter plot that shows the big curves, like the 2018 trend line, 2017 trend line, 2019. The reason that we do it just raw straight from EIA is because the change in storage is equivalent to the total supply minus total demand, and that way we don't have to have any models that could introduce model risk. So it's kind of a clean way of looking at it, but still you still have some assumptions in there about like how you weight your temperatures. But we'll think about how to do that, because you could back out some of the individual components and get a better look at, say, like power demand. Let's see, what else do we have? Any thoughts about where storage could end next spring, given a normal U.S. winter demand and the high LNG demand globally? So let's just say this. Let's just say that LNG is, you saw what the European stocks look like, very low. They're going to need gas this summer and into the fall probably. So let's just assume that they're going to take their
max
rate, and the globe will need the max rate of U.S. LNG. Well, if U.S. LNG increases in capacity, say by January, of about 2 BCF a day, do you think production is going to rise by 2 BCF a day? I don't think it's going to rise by 2 BCF a day. I'd give it some, but not that much. And so what that means is that we would be separating from like that 5-year average build and withdrawal rate that you typically see, and instead we'd be lower than that. So injections would be smaller coming out of the spring, and when the withdrawals would be larger than you would expect. So I'm not sure where that ends next spring. Of course, depends on weather, but that gives you an idea that you should be tightening up your supply-demand balance as we get to winter. Jay, can you point out to me like the other ones we had? I think there was one about the impact of inflation on that coal to gas switching. I'm just going to say it's like that. If I get it wrong, then I'll come back, or Jay send me a note. But I think the question was, does inflation affect the coal to gas switching chart? So I don't think it does, and here's why. It's because power consumption in the U.S. and natural gas consumption in the U.S. is not very price elastic. And there's a lot of reasons for that. Number one is that the typical consumer gets to hide behind a utility that absorbs a lot of the price fluctuations, and so it gets spread around. So I don't expect that inflation is going to be, directly affecting that relationship. Maybe if it affected coal prices, but I'm just not sure how that would play out. Okay, I think there was one more, and then the ones that came through email will just answer you directly. But I think that's it. So if there's not any more questions that come through right now, just realize that send us a note. We'll be happy to respond to you directly, especially if you didn't want to say it in front of everybody. And thank you very much for joining us today and for being a client. And we'll talk to you soon.